She saved for 30 years. She never touched her 401k. She paid off her house. She waited until 67 to claim Social Security. By every measure, she did everything right. And then she got a tax bill she never expected. Then Medicare started charging her more. Then the IRS took a cut of her Social Security check she didn't know was coming. By the time she understood what happened, more than $200,000 of her retirement savings had gone to taxes and premiums she never planned for. Not because she made bad decisions, because nobody told her about 3 rules that quietly work against careful retirees every single year, and the damage is permanent. My name is Clara Morgan, and on this channel we explain Social Security, Medicare, and retirement income rules in plain English. Today, I want to walk you through 3 things that are quietly costing careful retirees tens of thousands of dollars, and in some cases, over $200,000 across a 20 or 30-year retirement. This video is for you if you've been saving diligently, if you are on Medicare or approaching it, if you are already collecting Social Security or planning to, or if you have a traditional IRA or 401k and you plan to withdraw from it in retirement. If any of those describe you, what I am about to share directly affects your money. And knowing this now, before these rules hit, is the difference between an expensive surprise and a plan that protects you. Here is what most people believe about retirement taxes. They believe that once they stop working, their tax burden will be lower. And for many people, that is true, at first. But there's a second layer of retirement taxes that most people never see coming. Not the income tax they already know, a different set of rules. Rules that specifically target retirement income, Social Security benefits, and Medicare premiums. These rules were written decades ago, and they have never been adjusted for inflation, which means every year, more and more retirees get pulled into these tax traps, even if their income has not actually increased in real terms. There are 3 of them. I'm going to explain each one clearly, show you the real dollar impact, and then tell you exactly what can be done about each one. Let's start with the one that surprises the most people. The SS Tax Torpedo. Trap number 1 is called the Social Security Tax Torpedo. Most retirees believed their Social Security check is theirs to keep. But here is the federal rule. Depending on your total income in retirement, up to 85% of your Social Security benefit can become taxable income. Let me show you how this works. The IRS uses a formula based on something called provisional income. That is your regular income, IRA withdrawals, pension, dividends, interest, plus half of your Social Security benefit. For a married couple filing jointly, if that combined number exceeds $44,000, up to 85% of your Social Security becomes taxable. Now, $44,000 sounds like a high number, but think about what the average retired couple receives. Average Social Security for a couple is about $3,700 per month. That is $44,000 a year in Social Security alone. Add even a small IRA withdrawal, say $12,000, and you are already past the threshold. Here's the part that stings. These thresholds were set in 1983 and 1993. They have never been adjusted for inflation, not once. Which means a retiree today with genuinely modest income that in 1983 would have been considered middle class, can still be pushed into full taxation of their Social Security. One financial research firm calculated the lifetime impact of this single rule for a typical retired couple. Over a 25-year retirement, it can quietly cost them between $80,000 and $120,000 in taxes they were not expecting. That is the tax torpedo, and most people never know it's coming until it has already hit. The IRMAA surcharge. Trap number 2 is something called IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. In plain English, it means Medicare charges you more every month just because your income crossed a certain line. In 2026, the standard Medicare Part B premium is $202.90 per month. That's what most people pay. But if your income from 2 years ago exceeded $109,000 as a single filer or $218,000 as a married couple, Medicare adds a surcharge on top of that standard premium. At the first tier, that surcharge adds about $96 a month per person. At higher income levels, the total monthly Part B premium can reach $689.90 per person per month. Here's the part that catches careful retirees off guard. Your IRMAA surcharge in 2026 is based on your income from 2024, 2 years ago, not what you earn now, what you earned then. So if you did a large Roth conversion in 2024, even a smart, well-planned Roth conversion, that one decision may have triggered a higher Medicare premium in 2026 that you are now paying every month. Or perhaps your last year of work was a high-income year. You retired in 2024, your income dropped to almost nothing in 2025, but Medicare is still billing you based on 2024. Here is what makes this especially painful. IRMAA is a cliff system, not a gradual increase. If your 2024 income was $217,000 as a couple, you pay zero IRMAA surcharge. If it was $218,001, you pay the full first-tier surcharge for the entire year. $300 of extra income can trigger nearly $2,300 in extra Medicare premiums for the year for a couple where both spouses are on Medicare. For a 20-year retirement, that kind of premium difference can add up to tens of thousands of dollars above what most people plan for. The RMD Tax Bomb. Trap number 3 is one that is set years before retirement, but does not explode until your 70s. It is the RMD Tax Bomb. RMD stands for Required Minimum Distribution. Starting at age 73, the IRS requires you to withdraw a minimum amount from your traditional IRA and 401k accounts every year, whether you need the money or not. The withdrawal amount is calculated based on your account balance and your age. As you get older, the percentage required increases. Now, for most careful savers, here is the problem. By the time they reach 73, decades of tax-deferred growth has built up a significant balance, and that required distribution, which can easily be $30,000, $40,000, or $50,000 per year, is counted as fully taxable income, which pushes them past the Social Security taxation thresholds we talked about earlier, which raises their Medicare premiums through IRMAA, which can push them into a higher tax bracket than they were ever in while working. All 3 traps working together in the same year on the same retiree. This is how someone who saved carefully, did everything right, and built a real retirement nest egg ends up paying $200,000 more in taxes and premiums over their retirement than they planned for. Not because they made mistakes, because these rules interact with each other in ways nobody warned them about. The 3 fixes. Now, here is what actually matters and what you can do about this. Fix number 1 for the tax torpedo: Roth conversions before you claim Social Security. When you convert traditional IRA money to a Roth, you pay income tax now, but Roth withdrawals in retirement do not count toward provisional income. That means your Social Security tax bill goes down for the rest of your life. The window to do this is your early to mid-60s, after you retire, but before Social Security begins. That window is more valuable than most people realize. Fix number 2 for IRMAA. Know your 2-year look-back number before you make any income decision. If you're planning a large Roth conversion, a home sale, or any other event that generates income, run the IRMAA numbers first. If your 2024 income is going to be reviewed in 2026 and you have experienced a qualifying life event, retirement, divorce, loss of a spouse, you can appeal your IRMAA determination using a form called SSA 44. Many retirees who qualify for this appeal never file it. That's free money being left unclaimed every year. Fix number 3 for RMDs. Start reducing your traditional IRA balance before age 73 through strategic Roth conversions in your 60s. A smaller IRA balance at 73 means smaller required distributions, lower provisional income, lower Social Security taxation, and lower Medicare premiums for the rest of your life. Each of these 3 fixes works on its own. Together, they can save the kind of money that makes a real difference across a 20 or 30-year retirement. The woman I described at the beginning of this video, the one who did everything right and still lost $200,000, that story is not unusual. I based it on patterns that play out again and again for careful retirees who simply were not warned. Knowing these 3 traps now and which fixes apply to your situation puts you in a completely different position than most people your age. If this video helped you understand something you did not know before, please share it with a spouse, a sibling, a parent, a friend who is approaching retirement. This is the kind of information that genuinely changes financial outcomes, and most people never hear it until it is too late. And if you are not subscribed yet, subscribe now, because next week I'm going to cover something that affects every single person on Medicare, a hidden rule that could be quietly raising your premiums right now without you even knowing. That video is one you'll want to see before the end of the year. I'm Clara Morgan. Thank you for spending this time with me, and I will see you next week.